Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back. This is episode 193, Asset Consolidation with Matthew Tomlin. Matthew, thank you for joining me on the show.
Thanks for having me. Good morning.
You've been dodging me.
I know, I've been slow playing you.
You definitely have. If you've worked on our team for a while now, definitely been in the weeds, meeting with clients, going over financial plans. So thank you for carving out some time this morning to talk about asset consolidation with me and the millions of people across the world who are watching this or listening.
Yep. Hello, everyone. Happy Friday.
That's right. Happy Friday. We are recording this on a Friday. But before we dive into asset consolidation, Matthew, I wanted to just introduce you to our audience because many of our clients already do know you, but I kind of want to just go over your background. So maybe kind of just kick off when you started working with Falcon Wealth Advisors and kind of where you came from.
Yeah. So it's already been 2 years since I've joined the firm. So, time flies. But I graduated from the University of Missouri, so Mizzou.
Nice.
The only Mizzou team member here. I'm surrounded by KU folks.
Yeah, so far.
So far, yep. But I studied personal finance down there. After graduation, I joined American Century. They're a large local mutual fund company. So I started off there working on their business retirement side. So helping people with their 401ks, simple IRAs, really helping them with their asset allocation, doing trades, rebalancing, so on. But while I was there, I got fully licensed. I have all my advisor license, and I'm also a certified financial planner, a CFP. But after getting that CFP designation, that's when I really started looking for advising firms, just like Falcon Wealth Advisors, so I can implement that education and help people a little bit more than just doing trades and rebalancing. So been at Falcon 2 years, worked directly with Jake and a lot of our clients doing financial planning, doing follow-up. Really, I'm just here to assist, Jake and our clients in whatever form that may be.
Yeah, perfect. Thank you. And many of our clients don't know this, but we're approaching 700 clients that we work with. And so every single client either works directly with myself or with Corey, the other owner. And so Matthew is helping me advise and work with approximately 400 clients that you and I and Jake Cross, our other financial planner, kind of all work with together, almost like a committee where, if I'm not available, Matthew can step in or call a client back or even meet with the client. And so it's been a really huge value add to our clients as well, because I am actually not a CFP. And I'm going to go into that a little bit more detailed. I am a chartered retirement planning counselor. So my education has really been built on Social Security, IRAs, Roth IRAs, 401ks, Medicare, pensions, things that a lot of our clients are dealing with. And that's why I focused my education. But I love the CFP designation because it's definitely, in my opinion, one of the top accreditations that you can get out there. And Matthew, maybe why don't you go into a little bit more detail exactly what that took for you to receive that designation and kind of what topics does it cover?
Yeah, certainly. So the CFP, basically how you would become one, they call it the 4 E's. So the first one is education. So down at Mizzou, all my classes were centered around financial planning. So I had a class that was all about estate planning, retirement, insurance. So all those courses led up to the education requirement for the CFP. The next one was sitting down and doing an exam, which is about 6 to 8 hours of just testing. So it was a very long day, but that covered, insurance, estate planning, retirement, investments, like general planning, which would be like education planning, then also behavioral finance, and also like psychology of finance. So it's very encompassing and very widespread. The next is work experience. So in order to be a CFP, you have to have at least 3 years of financial planning experience or in just the general finance field. And lastly, it's ethics. So I do a course on ethics. Then each year, I have to do continuing education, so at least 15 hours to stay up to date on the most current kind of laws around financial planning, and also just different changes like tax bills or different planning strategies for clients. And each year I have to do another ethics course because the CFP board, if anything happened, they would be the ones to kind of step in, see if there's anything committed, and then there's a whole review process. So at all times I have to act as a fiduciary, or the board would step in.
Yeah, that's great. Yeah, so it's definitely a lot of work. Thank you for the time I know you spend staying on top of your continuing education and the new rules as they roll out. And you've really been a great addition to our team over the last couple of years, bringing that background and that bench of knowledge to our practice, and most importantly to our clients. So it's been
Yeah,
very good.
I enjoy it. I love doing this, so I like to nerd out on it. So
well, I can tell, and I always used to say that we used to do these seminars, and I would say we're a bunch of dorky finance guys, right? But that's what we all love to do here, and that's what clients want, right? They don't want us to be these guys going out partying every night. Like that's not probably who you want managing your money or helping you with complex planning strategies. So good. So thank you for sharing that. Also, you're engaged, right? So wedding coming down the pipeline, and a big basketball player, right? Or formerly played basketball, I guess, growing up.
Yep, I got engaged last October, and we're getting married next March on St. Patrick's Day, actually.
Yeah, that'll be a good one. It'll be a fun wedding.
Yeah, so we're in the heat of the planning season, but fortunately she's doing most of it, so I'm not too stressed out.
Yeah, I got lucky with that too. Yeah.
Yep, love basketball. Grew up playing it. Unfortunately, I wasn't good enough to go to college, but I need to get back into it.
Yeah. So were you a guard, forward, or?
Yeah, point guard, shooting guard. I just love sitting in the corner on the 3-point line and cashing those threes.
That's not an easy shot with no backboard, right?
No, I mean, you just have to swish them at that point, but
yeah,
the corner is my spot.
Yep. Is it? Nice. Yep. Nice. Good for you. Okay. All right, good. So getting into the topic of today's show, and thank you for sharing your background, is I wanted to talk about asset consolidation, because I think I've been noticing some of our clients, maybe not so much confused, but they don't understand that there's a strong case to do that more so. And so what I'm really talking about is that there's a huge misconception, especially when I meet with a potential new client, that they don't want to put all their eggs in one basket, right? And so Matthew, maybe you can talk about a little bit about what that, because I think they've got the definition wrong of what really all of your eggs in one basket means. So from your training through the CFP coursework and things that you've read and being an advisor, maybe you can comment on what that really actually means.
Yeah, so that's a very common misconception. If you have your assets, 10 different places with 10 different advisors, you're diversified. But those 10 advisors, they might have you in 10 different products, and they might have a different name, but ultimately they're the same investments. So for example, you might own Microsoft at 10 different places and 10 different funds. Think you're diversified, but a significant amount of your portfolio is in that one concentrated stock.
Right.
So what really diversification means to us is not just having assets in 10 different places, but having it in 10 different investment types or kind of vehicles. So we would have, large cap growth, but then we would also have a small cap value as an example, or bonds, and a portion of your assets in cash. So that's more of what diversification is, not just having your assets, spread across the place.
Right. So having multiple, so putting all your assets with one firm or one practice is not all of your eggs in one basket, even though it might feel that way. And actually, there's a stronger case for doing that, because like you just mentioned, and thank you for that point, is that if you have 10 different advisors, or even 2 or 3, sure, we can kind of talk to each other, and there's a lot of technology where we'll link up your accounts so we can see what your other holdings are. But the problem is that other advisor is buying or selling something, and we're buying and selling something. In the end, you could actually be putting a lot of damage to your portfolio and your retirement plan, and in fact, overexposing yourself or underexposing yourself to certain markets. And so most all of our clients are consolidating their assets here. But like Matthew, like you pointed out, we are diversifying amongst real estate, cash, commodities, large, small, international, right? So we can kind of control and see that landscape versus them, some people think they're diversified or don't have all their eggs in one basket by putting, things in different buckets. And there's also, I think, maybe we can talk a little bit about from a tax planning perspective, right? So if you don't have your assets consolidated, it's much more difficult from a tax planning perspective. I know you've been doing more of that for our clients lately. So maybe can you comment on why that's important?
Yeah, one of the biggest one is just tax loss harvesting. So especially if taxable accounts, brokerage accounts, if we have the whole picture, we can potentially lower your capital gains because we could say, this investment might be down a little bit, let's sell this at a loss to offset some gains. Versus if everything's spread out, you might have capital gains at one place that, there's nothing we could potentially do about it. Also, whenever you're getting close to retirement and we're wanting to take withdrawals, and we could be more tax efficient on where we pull the assets. So we could take some from a taxable account, maybe some from a Roth, and some from an IRA. It gives us more planning opportunities rather than just being in the dark. Yeah, go ahead.
No, yeah, that's huge. That's a good point because again, if you've got an IRA with another advisor and an IRA with us, and you take a large distribution from that other IRA and we don't know about it, or maybe you tell us, but you tell us months after the fact, well, then that, we could have been doing some other tax planning for you. And in the end, you could end up paying a lot more in taxes just by not, and again, and that's great if you want to organize that and quarterback that process. It's putting a lot of work on the client to always keep both advisors in tune on what's going on. And that's really difficult to do. And it's a big ask, frankly. And so now, obviously, there's a conflict of interest here, right? Like, of course, us, being wealth advisors, we want to manage most all of our clients' investments and their assets. But I've been doing this long enough. I'm coming up on my 16th year of practicing, and clients that have it pieced out on other places, they're really just not getting the full value that clients that do have it consolidated, do have it under one house. Even if we set it up in multiple accounts here, that's fine. And if certainly we're going to be diversified, but just having, multiple advisors or trying to manage some on your own versus what we're doing, I haven't seen their plans and their performance. I'm not saying that it can't, but I just haven't seen it work as beautifully as perhaps a client that has everything, consolidated and diversified so that we can give them, our full advice versus just kind of looking at a piece of it at a time.
Yeah, one thing I would add to that also is I've seen tax efficient accounts like an IRA have tax-free bonds in it, which is a big no-no. So one thing, if we have all the accounts, we can make sure the investments within each account align to be more tax efficient, to where maybe a taxable account would have those municipal bonds to really take advantage of the tax-free part of it versus being an IRA that's tax deferred. So there's a lot of structuring we can do with just investments within these different type of accounts also. That's
a really good point. That's a really good point. Now, again, and I'm not suggesting that we consolidate everything either. Like if you've got a checking and a savings account that you like to leave in cash, by all means, there's no reason for you to bring that to us, right? So, but what we're really talking about are retirement accounts, brokerage accounts, things that you're going to invest and use for retirement or some financial goal. That's really what we're talking about in here. And so hopefully we cleared that up a little bit, but that again, having all your eggs in one basket does not mean hiring one wealth advisor. It's also like a good analogy would be, I typically only go and see one dentist, right? I don't have 4 dentists. Who would want 4 dentists?
I wouldn't.
Right? So I go to one dentist. I trust him. I trust his opinion, his staff's opinion, and that's who I go to. And if something changed or I didn't agree with his philosophy or his service, well, then I'd probably go to another dentist, right? But I'm not going to my dentist and saying, hey, I only want you to look at my top teeth. I'm going to go to the other dentist to look at my bottom teeth, right? That would make no sense. right?
And
so,
you have to pay 2 people.
good point. And that's
Yeah.
another good point, actually, for our third point on asset consolidation, is that there's break points that clients hit by consolidating more assets. So we actually lower that rate. That's a good one that you brought up. So if you get above 2, 3, 4, 5 million, you're going to pay a lower rate within, typically, not all advisors, but typically most advisors. So again, even if you're not consolidating with us and you have an advisor, I would encourage you, if you trust that person and they're acting as a fiduciary, which means they're legally bound to give you advice that's in your best interest. If you're doing that, you should talk about, hey, if I give you more money, do I get a break in my cost? Because we do that at Falcon Wealth Advisors. And so you may be able to lower your overall rate, and then in turn, that could potentially help you out performance-wise as well. So that's a good one. Yeah, and I wouldn't want to pay 2 dentists. I wouldn't want to go to 2 dentists.
No, you don't want to get nickel and dime of, account fees and everything else there.
Right. So it's a good case. Again, there's a little bit of a conflict of interest. Obviously, we do get paid more, but that's why we give a break point for the more assets that you do have with us, and we lower that cost. But ultimately, we just want to be able to do our jobs to the fullest extent. And to do that, we'd love to have discretion over the entire portfolio. We'd love to have a clear picture so we can do our tax planning, we can do diversification and investment management. So that's really what with our clients, at least, that's what I've seen work the best, is when they do that. It's the clients that have an account over there, that they're managing themselves, and they may have an old advisor, and then they have us. And it's like, well, you have all these moving pieces. And like you mentioned, you may be over or under diversified, or from a tax perspective, it might not be as efficient as it should be or could be. And then again, you might be paying way too many fees from having all those different accounts in different places. Good. Is there anything else I missed on the case or asset consolidation?
Yeah, another thing I've seen is from a withdrawal standpoint, whenever people turn 72, they're required to take a distribution from their pre-tax IRAs. And if they don't take those distributions, they get hit with a pretty hefty IRS penalty, up to 50%. So with some people I've seen, they'll take a distribution or RMD from one of their accounts at one place, but then they'll forget about the other. And then come tax time, they have to take that additional amount plus another 50% goes to IRS as a penalty. So that's another big case for clients, especially as you get older, just to kind of simplify your life. Then the next would be, it's kind of morbid, but for estate planning purpose. Do you want your heirs to call one place, or to track down assets at 2 or 3 different advisors? They have their own process. They might be difficult to work with. So also simplify your life that way.
Yeah, those are 2 really good points. Yeah, so that's what's tricky on those IRA required minimum distributions also, is that the IRS doesn't care if you have 10 different IRAs. They see it all as one. So you have to take one big required minimum distribution, which can make it even more confusing, because technically you could pull all of it from one IRA as long as you satisfied all 10. So that, again, that's a lot to ask for somebody in their 70s that's supposed to be in their prime time of their retirement and enjoying themselves. It's like, do you want to go through that every year?
I wouldn't.
I wouldn't either, right? And then again, you're right, from the estate planning perspective. It's it's already an emotional time, a tough time on many families, and we've been through that with clients as well that where their parents or whomever had accounts all over the place, which is great because they saved money, but for the beneficiaries it can be rather cumbersome, and then you've got to worry that you've got beneficiaries properly listed on all those accounts that you have open all over the place.
That's a huge point right there, because if you don't have a beneficiary properly titled, it can slip through to probate, and then your heirs going to have to get a lawyer. They're going to have to go through a lengthy process. It's all going to be public information. It's going to be public records too. So there's a lot that can kind of slip through the cracks, having everything spread out.
Yes, yeah, you definitely want to try to avoid probate because it can be avoided. And so again, by having things focused, having a team of fiduciaries, and that's one thing that, again, I value at our team. We now have 13 professionals working for our clients. So there's multiple sets of eyes, ears. And again, so you're not just relying on me or Matthew. We actually have a whole team approach as an ensemble practice. We're all working with our clients in there, and then we're diversifying everything. But again, You don't want to slip through and have $1 million in an IRA with no beneficiary, and then something happened, because then it could take literally months in court and legal fees. And especially if your heirs need that money, then they're not even going to be able to get it.
Nope.
And so until that process, of course, is finalized. So again, that's a big one too. And again, just keeping it simple. That way you don't have to, your heirs aren't going to have this huge burden placed upon them when they're already probably going to be pretty emotional and upset to begin with.
Yeah.
So good. Thank you for those additions. So perfect. Well, I know we're recording this on a Friday morning before our team gets in. So we'll go ahead and wrap it up. But do you have any fun activities set up for the weekend? Spring is here in Kansas City. It was a nice day yesterday.
Yeah, spring's here. I think tonight, Friday night, we're going to get together with some friends. Saturday, we're going to go to the movies. And Sunday, it's my day to mow. Mowing day. Back. Yep.
Good for you. What movie are you going to go see?
The new Fantastic Beasts. So it's got like the Harry Potter theme to it.
So is it the prequel? I think it is, right?
I think it is the prequel. Yep.
Yeah, my wife was talking about that. I don't think she's watched any of those, and she's a huge Harry Potter person. Are you a big Potter fan?
I am, but I haven't read the books, so
No.
I've only watched the movies, and people always say I need to because the books are better. But
fair enough.
At this point, I feel like I'm a little old for it.
Yeah, and you got the gist of it, right? You get the story.
I know what happens.
That's so good. Well, good. I think for me, I'm going to try to play some golf on Sunday. Do some running around with Rachel maybe tomorrow, run some errands. We're going to watch, I think it's on Apple TV. They did a Abercrombie and Fitch documentary. So we're going to we might watch that tonight. We like watching movies and shows, but we still haven't ventured out to the theater much. I guess there's probably no masks anymore, right? I mean, I'm thinking.
Yeah, we haven't been in a while, so this will be our first time, but hopefully it's still kind of spread out.
Yeah.
But I know the movie theater next to us, AMC, they have like those fancy chairs that recline and they're heaters now. So it should be a good experience.
Good. Well, we'll have fun, stay safe. And thank you again for joining me on this episode of Upticks. And thank all of you out there for tuning in. If you haven't already liked and subscribed our show, please feel free to do so. You can also find me out there on social media. I'm on Instagram, Twitter, LinkedIn, and Facebook. My email is jake@falconwealthadvisors.com. Matthew, what's the best way to get a hold of you if anybody watching the show has any questions for you?
Yep. My email is Tomlin, Tomlin @falconwealthadvisors.com.
Perfect. Well, thank you again. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.